Let's examine this chart together. Gold prices are skyrocketing like a rocket. But this doesn't really resemble what we could call nice market movements. It's more like someone drinking energy drinks at midnight and watching videos to pump themselves up. Let me explain. Over the past 40 years, gold has brought rises of around 6 to 12% annually on average and made profits for its investors. It was a nice and healthy investment tool. But when you look at the last 5 years, we observe that gold has had approximately a 20% annual return for its investors. This means there's a serious situation that shouldn't exist under normal conditions in the economy, which indicates one of two possibilities. Either we're not in a normally functioning economy, or I'm seriously underestimating people's emotional relationship with these shining metals. Although there's been a slight pullback lately, as I write these lines, gold is most likely hitting a historical peak again. But stay calm, because things get even more interesting. And what's really strange is that nobody agrees on the real reason behind this situation. Not investors, not economists, not market experts, not even that friend who spends half their day preaching on internet forums about the future is in precious metals and canned food. It seems everyone has their own opinion, but there's no common answer. Very different things are happening behind the scenes. An investment tool that's expected to be ordinary and stagnant is now putting up incredible numbers. Today, we're going to figure out what this big thing is. So let's start and debunk that explanation everyone thinks is obvious. Inflation. Of course, inflation is annoying because rent skyrocketed, grocery prices increased, fast food prices jumped so much as if chain restaurants are being managed by investment funds. But I have to say this truth. Gold isn't rising because of inflation. At least not in the way everyone thinks. If it were just moving against inflation, it would have already exploded back in 2021 when inflation peaked and jumped around like a cryptocurrency. But it didn't. In fact, it barely moved at all. Gold gaining momentum is a much more recent phenomenon. So yes, inflation is part of the story, but that's not the only explanation, meaning there's something else going on underneath. And that something is quite frightening. Countries around the world are quietly losing faith in the American dollar. When I say quietly, I'm talking about the kind of quiet where someone silently deletes shared photos from Instagram before breaking up with their lover because the signs were always there. Only nobody ignored them. For 80 years, the US dollar has been the world's primary reserve currency, meaning it's the currency that central banks hold in large volumes in their reserves to facilitate international transactions and reduce exchange rate risks. But recently, central banks around the world are showing a change in attitude. However, they're not directly abandoning the dollar. That would be too obvious and carries too high a risk of triggering global panic. What central banks are actually doing is much more cunning. They call it portfolio diversification away from the dollar. Not abandonment, diversification, slowly and strategically, as if trying to leave the room without waking a sleeping monster. 20 years ago, central banks held more than 70% of their foreign exchange reserves in US dollars. Today, that ratio has fallen to 58%. A 12-point drop might not sound like much, but we're talking about global central banks. We're talking about trillions of dollars. Essentially, central banks are sending the message, we're still with you, but we're also looking at other options. And these alternative options aren't the euro, not the Japanese yen, not the British pound. Gold. Gold is the backup plan, the financial insurance, the just-in-case strategy. And central banks are accumulating gold at record levels because for the third consecutive year, central banks have been buying over 1,000 tons of gold annually, which is more than double the previous decade's annual average of 400 to 500 tons. In fact, 2024 went down in history as the highest gold purchase year ever. And this purchasing trend isn't slowing down because more than 40% of central banks have announced they're planning to buy more gold over the next decade. While 95% of central banks expect gold stocks to continue increasing over the next year, we can now say this isn't a temporary trend. This is institutional anxiety. Central banks worldwide have started worrying about America's debt burden, long-term inflation threats, and overdependence on the US financial system. Gold, meanwhile, is the asset they turn to when their confidence is shaken, but they don't want to create open conflict. Don't get me wrong, the US dollar isn't going away tomorrow. It's still at the foundation of the global financial system. The dollar is collapsing rhetoric you see on social media is usually written by people living in their mother's house and hoarding a bunch of silver because the dollar is still the dominant currency in the world. However, we're seeing central banks shift from blind faith to conditional trust, and this is alarming because gold doesn't rise when people are optimistic. In fact, when confidence is high, gold is boring. When markets appear stable, gold is stagnant. When institutions feel secure, gold gets ignored. Gold only revives when stability starts to deteriorate. This is where the importance of this movement comes from and why I'm making this video. Because what we're seeing right now isn't panic buying. It's preemptive positioning. Central banks aren't reacting to a crisis that's already happened. They're taking precautions against a future they don't fully trust. But here's the confusing point. The stock market is approaching historical peaks. Risky assets are as enthusiastic as if they're in a nightclub, and AI stocks are being valued as if they've already laid off half their workforce. But at the same time, gold is also playing at the peak. And this is not normal at all. Historically, markets choose one direction. Either risky assets like stocks and real estate rise because confidence is high, or safe haven assets like gold gain value because fear is increasing. Both rising at the same time normally isn't possible. We're seeing a world where stocks are priced with optimistic growth expectations, gold with a troubled future forecast, and bonds with confusion. It's as if every asset class is sending signals from a different mindset. This discord in the markets creates an environment where two different people can look at the same data and come to completely opposite conclusions. We're getting more mixed signals than someone who says, "I don't want a serious relationship," and then asks, "What's your love language?" So write your thoughts on this matter in the comments because that's usually where the real debate begins. And there's one thing for certain. Markets don't behave this way when the future is uncertain. That's why this gold movement is important. Not because gold is shiny, not because it's breaking records every week, but because of who's buying the gold and why they're buying it. Because the biggest leaders in the global financial world are quietly repositioning themselves and nobody is talking about it. Gold has never upset its investors who held it in the long term until now. But will it continue not upsetting and make its investors happy from now on? Or will it be a disaster for its investors? And this situation is worth following. My opinion, of course not investment advice, for those who will hold long term, gold is always a safe haven.